And if manufacturing suddenly rebounds short term, that could prove to be a game changer for right about every asset class. And I actually think that it kind of explains what we see in equities, what we see in foreign exchange markets, what we see in interest rates, what we see in commodities now, if the manufacturing cycle is improving rather than the opposite right now. The signals are telling me to watch the developments in the US dollar very closely at this juncture. Welcome to this live edition of Steno Signals. As every good Scandinavian, I'm sending to you live from my wooden vacation home over summer here. And today we're going to spend some time on elaborating on the most recent trends seen in the US dollar. The trend towards a weaker US dollar has wrong-footed me. Let me just put that up front. And I think it's very, very interesting to look into why the US dollar has weakened. And to assess why the dollar has weakened, we need to take a step back and look at the business cycle first, because the weak dollar could be a sign of a major surprise to the economic outlook. If we look at the manufacturing cycle in the US first, we've actually seen some very early green shoots over the past month or two when it comes to the manufacturing PMI outlook. If we look at the orders to inventories ratio in the ISM manufacturing PMI, we've actually had an increase in that ratio, meaning that orders have surpassed the momentum in the inventories over the past month or two. And that is typically a harbinger of something positive for the overall activity level with the time lag of 2 to 3 months. So do we actually have a change of scenery upcoming for the cyclical part of the economy here, with an improvement to the activity level in the manufacturing and goods production? That would be a major game changer to the global outlook, since we've been stuck in a discussion on when the weakness in manufacturing would spill over to the rest of the economy throughout the first couple of quarters of the year here. And if manufacturing suddenly rebounds short term, that could prove to be a game changer for right about every asset class. And I actually think that it kind of explains what we see in equities, what we see in foreign exchange markets, what we see in interest rates, what we see in commodities now, if the manufacturing cycle is improving rather than the opposite right now. We've been talking a lot about China so far this year. The reopening took place in the early parts of the year, and Chinese economy was allowed to grow again by the authorities, also via increasing credit. And if we look at the typical correlations between a positive credit cycle in China and the subsequent moves in global manufacturing, we're actually about to enter the stage where the Chinese momentum will pass through to a positive momentum in global manufacturing. As you can see on the chart here, there's a typical lag of, say, 3 to 4 quarters between the pickup in Chinese credit momentum and the pickup in manufacturing momentum worldwide. In this case, the US manufacturing momentum in light blue. And as you remember, the reopening happened towards the very latter part of 22 and into the early parts of 23. So if this 3-quarter lag replays itself, then we should expect the manufacturing momentum to gain a bit of pace through the third quarter and into the fourth quarter here. As you can see from this chart, it may be a very temporary upswing in manufacturing, but still an upswing worth noting, and something that could postpone this whole recession chatter another while for the US economy. And typically, what we see in markets when the manufacturing cycle starts to improve a bit is that cyclical commodities such as metals, but also chemical commodities, start to improve price wise before we see the actual pickup in the momentum in the PMIs. And if we look at the relationship between industrial metals and the ISM manufacturing in the US, we actually see the first green shoots in the commodity space as well. And I think it rhymes very well with this weakness we've seen in the US dollar over the past couple of weeks. So if we look at the momentum in copper, zinc, aluminum, and other industrial metals, we actually see the first signs of a pickup in industrial activity worldwide. which is a complete game changer to what we've grown accustomed to over the course of the past 2-3 quarters here. And therefore, I would strongly urge you to watch the price action in the industrial metal space and the spillovers to the manufacturing industry if these trends persist into the third and fourth quarter here. And maybe there's something ongoing beneath the surface driving all of this. I've been watching global money trends for years now, and I find it very interesting that we see a slight pickup in the broad money supply in both US dollars, but also in other major currencies over the past month. That is in sharp contrast to the liquidity outlook, generally speaking, meaning that this is credit creation from private banks and from the private sector, not from central banks. As you can see from the two arrows here, we've seen a small uptick in the so-called M2 measure. So the broad supply of US dollars, the broad supply of sterlings, and the broad supply of euros over the past month. And typically, we see such a pivot or a turning point in the global money supply when interest rates start to decline. But from a rate of change perspective, we've obviously seen a decline in long-term interest rates in many of these countries over the past 2 quarters. If you look at the 10-year interest rate or the 30-year interest rate, we're still below peak seen in June 22, for example. So we have seen a small decline, and that could be the reason why we see this pickup in the private money creation in the economy again now. And I think that is a major turning point to watch as well if we get that improvement in the broad money supply via private credit creation, via a new credit channel, also through housing, etc., into the third quarter here. And I think this is a major explanatory variable behind the pickup in risk sentiment that we've seen lately. If you look at how investors position for this cyclical rebound in the economy, we also now get the first signs that investors have started to chase the economy higher, so to speak. I typically watch the so-called AAAI investor sentiment bull-bear spread. And as you can see from the light blue chart here, we've slowly but surely moved towards investors getting increasingly optimistic around the cyclical outlook for the economy. And that is also something that we typically see ahead of the economy actually turning. So we don't know yet whether this is a false flag, but we get a lot of small hints that the economy is about to turn more hot, not less hot, from a cyclical perspective through the third quarter here. And that is a major surprise, both to the economic consensus out there, but also to a lot of money managers and fund managers still bearishly positioned, awaiting this recession that we've been talking about for potentially too long, to be honest. And if this rebound is indeed true, then being long equities is still the play here. Thankfully, I've been long equities throughout the year. I entered the year with a contrarian view that positioning was too bearish. And even though I've been tempted to try and take profit a few times, I've thankfully not done so. I remain heavily invested in the tech sector. I remain heavily invested in the AI theme. I remain heavily invested in Japanese stocks. So some of these stocks that would gain from this pickup in activity. As you can see here, there is typically a very neat correlation between the ISM manufacturing survey and the moves in the S&P 500, so the broad equity index. And I think one of the things that you need to watch now is whether this equity momentum turns more broad-based than just a few handfuls of strong performing stocks. And I think that will sort of be the next confirmation in equities that we're actually about to see a short-term pickup in activity if we get that broad-based equity rally now, which I see more and more green shoots supporting that narrative. And that is also why the move that we see right now in the US dollar is so interesting. The US dollar is a bellwether for global activity. I think that's fair to assume, generally speaking, since a lot of emerging market countries, but also other developed markets, still rely on cheap dollar funding and a supply of dollar liquidity via a transfer of liquidity via global trade to the rest of the world. And we actually see a pickup in dollar liquidity from global trade right now, which is interesting. And therefore, the move in the dollar towards a weaker dollar could also be seen as a very clear signal that the economy is actually gaining pace again, not the opposite. I've looked into the relationship between the DXY, so the broad dollar index, mainly versus euro, and the ISM manufacturing index. And as you can see, there is an extremely neat correlation between dollar moves 126 days ahead of the actual moves in the economy. And when the dark blue is skyrocketing as now, it means that the dollar moves in a weaker direction versus peers. And we've seen that in particular over the past, say, 2-3 weeks here, wrong footing my position, to be honest, in the US dollar. And that is typically something that we see ahead of the pickup in activity and in momentum in the global economy. So this long dollar view has taken a material hit over the past few weeks. I get a lot of feedback from professional clients of mine in the hedge fund industry and the asset management industry being wrong-footed on this, meaning that we probably need a complete positioning washout in this long dollar bet before we get to equilibrium levels in the dollar again, meaning that we could probably take a larger hit to the US dollar short term here. And if you look at the currencies that will typically be the winners if we actually get this pickup in cyclical activity. I think the Australian dollar is worth mentioning, for example. I've had a look at 10 years of history between the level of the PMI and the subsequent moves in foreign exchange space versus the US dollar. And essentially, the US dollar is the loser against everything if we get a cyclical activity rebound short term here in the global economy. When the beta here is negative, it means that the dollar versus the foreign currency loses value, meaning that the US dollar is essentially the biggest loser, globally speaking, in foreign exchange space if this cyclical rebound continues, as I find likely at least over the next month or two. And that also means that we get interesting signals from a global asset allocation perspective. If you're a non-US investor, you obviously need to watch this if you're allocated towards US stocks. I'm heavily invested in US stocks. I still think it's the right market to be invested in, but it also means that other countries may start to perform measured in US dollars when it comes to the equity markets. Japan is a great example of it, but also some emerging markets, selected emerging market equities may perform in this environment. I'm thinking about Brazil here as an example, but also Mexico could be another a great pick in an environment where the cyclical activity continues to rebound in the global economy.
Hi everyone, sorry to interrupt the video. It's Raoul here from Real Vision, the co-founder and CEO. Investing seems like a very complicated business. It's not that easy. But there are 5 key steps that you need to follow that will make you a better investor. Those are idea generation, fundamental analysis, technical analysis, investing psychology, and risk management. Get those 5 steps right, and you will become a better investor. That's what we've done at Real Vision. We've built an incredible online course experience for you to learn these 5 key steps. So go to realvision.com/the academy and take those key steps to make yourself a better investor.
And the interesting thing is that if the dollar is actually able to explain where the economy is heading, it may also be able to explain where equities are heading. And I've had a look at the correlation between the broad dollar index and the S&P 500 in relation to that discussion. And if we bring up the chart on the DXY versus the equity market here, we also get that the dollar tends to lead the equity trends by, say, 3 months, roughly 100 to a bit more trading days. And again here, it points to the fact or the relationship that equities have not rallied enough to sort of reflect the ongoing repricing of the cyclical momentum in the global economy. So yes, I'm still bullish here, despite the issues around liquidity from central banks, despite the recession risk, say towards the end of the year into early next year. I actually think it's a prerequisite for this ultimate recession that we get this pickup in activity, we get this positioning towards a bull market, and we get sort of a laid back attitude towards risks again. What happened throughout the first half of the year was that too many people were too worried about the whole situation. And you never get a recession in such a scenario where everyone has planned for one. The recession can only arrive if it's a surprise. We need an external trigger, and it's very tricky to get an external trigger if everyone is already worried. So I think this rally in equities that is still likely ahead um, could sort of pave the way for a positioning and a laid back attitude that could ultimately trigger a recession. But that's a discussion for later. For now, stay invested. I think that's the main conclusion here. And if we look at what that means for the overall sentiment in interest rates and foreign exchange as well, I think it's worth noting that we typically see a very strong correlation between a weak dollar when interest rates rise across the globe and vice versa when interest rates decline. And I have a chart on the historical correlation between the euro dollar and the average of 10-year interest rates in Japan, the UK, Europe, and US. And at least until the pandemic, we had an extremely neat correlation between the euro dollar picking up alongside the average of interest rates picking up. So it doesn't really matter whether spreads are high or low. What matters is the direction for global interest rates. And if global interest rates are on the rise, then it's actually pretty normal to see a weak dollar. And I think that's fair to say that we've seen interest rates on the rise, say, globally speaking, over the past quarters here, of course, especially in the short end, but also in some countries in the long end of the yield curve. The interesting thing is that we've had a weird correlation between the two in the area that I've colored pink here. So post the pandemic, we've seen weird correlations between rates and interest rate, and foreign exchange moves. So what could happen here is that we actually get a decline in interest rates while the euro continues to rally a bit against the US dollar. But typically speaking, once we get to the part of the cycle where prices start to come down, I think we are at that stage. The dollar will stage a comeback later. And let me show you a few charts on why that is. We've had the final print out of the Eurozone for the June inflation today. It was revised up a little bit to 5.5%, meaning that the inflation in Europe is now way above the inflation in the US. Way above is probably exaggerating it, but the spread is now 0.5% or thereabout. That's what you have on the dark blue chart here. So inflation is higher in Europe than it is in the US. And typically that would, of course, spill over to expectations that the European Central Bank will out-hike the Federal Reserve due to inflation pressures being broadly stickier in Europe than they are in the US. And I think that is essentially why the market is sort of chasing the euro versus the dollar higher now, even though the economic outlook is much worse in Europe than it is in the US. And I strongly confirm that still with my background in Europe here. But FX markets tend to lack the effects in inflation. And I think that's what we see now. Ultimately, European inflation will come down to US inflation. I just think it's a matter of lagged effects. The US cycle always leads the European cycle. So I think we're close to peak in that spread in inflation between Europe and the US. And once it starts to subside again, I think, or recede again, I think we will get the reversal in euro dollar. But that could be, say, 1 or 2 months away still. If we move 2 charts ahead, Gabriel, I have a chart on relative growth versus the US dollar. And I think this is the major chart to watch in terms of FX developments between the euro and the US dollar. If we look at the spread between expectations for growth in Europe and in the US, and we move them forward in time a little bit in the chart here, as you can see, we've had quite a move in expectations in Europe relative to the US since energy prices peaked back in Q4 last year, in Europe at least. And I think this has been sort of the major driver behind the resurgence of the euro, that all of the fears surrounding a complete meltdown of the European industry due to high energy prices has been taken off the table, at least for now. I still think there are structural issues in European energy. I will, by the way, host Mr. Doomberg next week on Real Vision to discuss the European energy outlook relative to the US outlook. I really, truly look forward to that. Doomberg is always worth listening to on energy. But what I'm trying to say here is that the driver of the euro through this period has been lower energy prices. And we're starting to get to the point where the impulse is no longer strong. Because energy prices have flatlined and even started to increase around the European continent. We see early signs of that in the US as well. So let me just highlight that in a month or two, that impulse will be gone, and I think the dollar will rebound. But I'll of course keep you updated on that here in the weekly Steno Signals show at Real Vision. Finally, let me just rephrase some of our positions. We've been stopped out of our euro dollar shorts, so the long dollar position. Thankfully, the rest of the portfolio has been performing like crazy over the past couple of weeks here, with long AI, with long Japanese stocks, and so on and so forth. As you can see here from the portfolio dashboard, we've entered a couple of interesting trades over the past week. We've entered a BCOM ETF, so an ETF tracking the broad-based commodity space. I also mentioned that, was it last week or the week prior to that, that I found more and more stars to be aligning for energy and commodities. And now that we have weakness in the US dollar, I think that's sort of the final catalyst for performance in commodities. We even see performance in the broad commodity space today, despite a small rebound in the US dollar. So I think that's a great trade right now, to be long broad-based commodities, or energy more specifically. It could also work in the equity space to be long energy stocks. And then we've added a steepener trade in the dollar curve. If we get this cyclical rebound, I actually think that the curve needs to shift upwards again so that we get a move in the long end of the curve relative to the short end of the curve. And that trade would work both if we get a recession and if we get a cyclical rebound. So it works in both directions. The only thing that would be against this trade is the macro picture going nowhere. So I think that 2-cent steepener trade is very interesting. And as you can see from the dashboard here, there is an ETF reflecting that trade. So it is also tradable from a retail-friendly perspective. Those were sort of the words for today. I'll jump into a few questions here. Richard asks me, what would change your mind on equities continuing to rally? Thank you. I love your work. Thank you very much for those comments, Richard. What I'm watching currently is the positioning in equity space. This week, we got the monthly survey from fund managers conducted by Bank of America. And it's still very clear from that survey that professionals are stuck behind benchmarks. So when benchmarks have rallied, mostly due to a couple of handfuls of stocks, investors being underweight will simply have to keep buying to try and catch up to that momentum that we've seen through the first half of the year. So we need to get more of the big players on board the rally train, so to speak, before I would consider reversing my bets in equity space. As of now, I don't see the positioning being bullish enough for that to be a consideration yet. So I would watch positioning on a weekly basis. We also put out a positioning watch at Steno Research every Saturday, trying to gauge this. And I'll, of course, keep you posted in this weekly show as well on positioning. For now, positioning is not long enough to be truly scared of a reversal in the positioning. Also, a question from Johan asking me whether emerging markets being the usual long trade here if the dollar softens further, and Johan is located in Scandinavia as me. So also asking whether the trend of stronger currencies outside of the US could bring inflation down, for example, in Sweden, where he's located, but also elsewhere around the globe. And I think that's a great observation that from an FX perspective, this will help some of the countries struggling with extremely high inflation. For example, Sweden, Norway, the UK. These three examples are great examples of countries suffering from high inflation due to a weak currency as well. But we will get a reversal of those currency trends now in the inflation prints, say from September and onwards, roughly. There's typically a time lag. And that is something worth watching into the second half of the year here. The reversal of trends in inflation elsewhere on the globe, meaning that the trends that we've seen in US inflation now printing below 3% will likely arrive elsewhere around the globe as a consequence of this. And yes, I think it is worth dipping your toes in some select emerging market equity markets as a consequence of this weakness in the dollar. I've highlighted Brazil as an example. If you're a true risk lover, oh boy, Chinese tech looks extremely cheap. I haven't dared entering yet. I'm already a bit underwater in my bet in Chinese real estate. But if you are a true risk lover, I would strongly urge you to look at that trade, the Chinese tech space. It hasn't moved anywhere despite tech going absolutely bananas across the globe. So worth watching as well. But Brazil is a good take in emerging market space. I also find select countries in Eastern Europe worthwhile watching. Poland, Hungary could be worthwhile watching. And if you could get access to broad LATAM exposure, I think that's worth a consideration as well, given this weakness, softness in the US dollar. I think I'll leave it at that for this week. Remember that this is a running sort of insight into my thinking around how to trade the global macro landscape. I think it's very interesting that we can get this cyclical rebound short term, and this rebound may be the actual prerequisite for the whole recession discussion to be worthwhile taking again. I'll of course keep you posted on that. I cannot guarantee you that you have the same risk horizon or the same risk appetite as me, but what I can guarantee you is that I'll update you on a weekly basis here in the Steno Signals show at Real Vision. Remember that we have an exclusive offer for the Real Vision community. If you want access to more of my written research, you can use the link on the screen to get 40% off on a subscription to Steno Research. Go to realvision.com/Steno, and you can use the coupon code RB40 to get 40% off your subscription. I welcome all of you as subscribers, of course. Thank you very much for watching, and thank you very much for the support out there. It's a true pleasure to send this show live to each and every week. I'll see you again next week.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.